anchor trader or developed trader. These are two types of traders that we talk about. What some of you that have been familiar with this, we are changing nomenclature. We used to call an anchored trader a fast trader. We used to call a developed trader a slow trader. Those terms didn't communicate with people. So now we're calling an anchor trader or a developed trader. And in just a couple of minutes, I'm going to show you what I mean by anchor. Anchor trades are a substitute for scalping. So many times, and I've said this before, only about 5% of the traders that came off the floor were successful going to screen-based trading. A lot of the things on the floor were scalping. And they come off and they try and teach scalping to off-floor traders. And off-floor traders think it's really sexy. Well, it doesn't work for off-floor traders. Let's look at the next slide. The anchoring effect is a cognitive bias whereby an individual's decisions are influenced by a particular reference point or anchor. Once the value of the anchor is set, subsequent arguments, estimates, etc., made by the individual may change from what they would otherwise have been without the anchor. The anchor is artificial. It's something that they see it, they make it as value or valuable in their mind, but in fact, it isn't. That is very valuable information, and we're going to see that very shortly. Okay, let's take a look at the next slide. Traditional anchors, half back relative to the entire session, half back relative to the prior 30-minute bar, previous day's high or low, half back from the previous day's range, half back relative to the overnight range, prior prominent, very prominent points of control. Additionally, prior weekly highs and lows, monthly highs and lows, along with highs and lows of unfilled gaps, also serve as anchors. From astute observations, you will continue to observe anchors. Let's look at the next slide before we make this real. Traditionally, scalping was a term identifying trades employed by floor traders. Floor traders had a distinct advantage in that they could buy on the bid and sell on the offer, which is the opposite of what you and I do as retail traders. When we buy and sell, we lose a tick going in and a tick going out. The floor trader didn't always do that because he could buy on the bid and sell on the offer. We have to do just the opposite. That is a tremendous advantage. Additionally, because floor traders helped exchanges build liquidity, they enjoyed another advantage. Their fees and commissions were considerably lower than that for retail traders. So there was a tremendous economic advantage from being a local on the floor and trading on the floor. I used to clear locals. So this is something I was a local. I cleared locals. I have a very high familiarity with this and what goes on. Okay, let's look at the next slide. Non-floor retail traders, without fully understanding scalping or enjoying the economic advantages of a floor trader, attempt to employ scalping strategies. Scalping to these traders generally refers to attempting to make a few ticks by reading and interpreting order flow. Even if these traders were not at an economic disadvantage, the selling of order flow by many of the broker-dealers to large institutional clients and hedge funds further disadvantages them. A lot of traders think I look at order flow. Well, these large traders, these large hedge funds and institutions are getting a microsecond look ahead of you with these very high-speed computers. And if there's anything to be learned in the order flow, they're taking it first. They're making billions of dollars. They only make pennies per trade, but it adds up to billions of dollars. One firm in Chicago spent, this is absolute true, spent $1 billion to put a phone line directly from Chicago to where the trades were cleared in New Jersey in order to get microsecond advantage from that. And that turned out to be a good investment. Again, what I'm trying to show you is some of the realities of what's going on, and some of this is going to upset you because you've been looking. I have people all the time. So, I buy or sell. Look at order flow. Oh yeah, no, I like order flow, and people teach order flow. They charge you money to come teach how to read order flow. Well, there's people ahead of you with big fast computers, and they're buying. I literally mean milliseconds head start. That's all they need with the high-speed computers. It doesn't work. There may be, for some people, what I say, if it works for you, continue to do it. If you're doing it and you're not profitable, you've got to rethink everything. Let's look at the next slide. By paying for order flow, large institutional clients, I've just talked about this. So the same thing, milliseconds, but it adds up. Anchor trade or develop trade. The personality of an anchor trader. Decisive, no attachment to any trade. And I'm going to clarify that in a minute. I'm going to show you some real examples. The anchor trader is very decisive. They're very quick. They don't overthink the situation. It either works or it doesn't work. The personality of a developed trader is more reflecting, and calculating. The developed trader, in many cases, will use the information gained from what he or she sees the anchor trader do in order to think in terms of odds and probabilities to do their developed trade. We recommend reading Daniel Kahneman's book, Thinking Fast and Slow, to get a better understanding of how different people process information. He uses the term fast and slow processing. Neither one of those is necessarily negative or positive. It's not negative to be slow processor. It's not positive to be a fast processor. They're simply the way some minds work. One of those is not negative, one is not positive. It's just a simple fact of how he finds minds work. It is a very meaningful read. A lot of people get involved in trying to do trades that they're not mentally equipped to do. It's just not the way their mind works. I am not a fast trader. Do I understand, or an anchor trader? Do I understand anchor trading? Yes, I do. Am I good at it? No, I'm not. It's just not the way my mind works. I can explain it to you. I can point it out to you. I use the information in order to focus on developed trades, which are more reflective and calculating. Both anchor traders and developed traders can take advantage of the opportunities presented on the same day. For example, an anchor trader might buy the early break to a single tick above unchanged settle and again just above yesterday's low. Developed traders who are more reflective might go to the next time frame and using that same information make a different decision. Developed traders might see these lows as weak and expect them to be taken and sell the rally. I'm going to show you this exactly in just a couple of minutes. It comes down to what personality you are. Are you someone that is a fast thinker and can make quick decisions? Can you exit a position quickly without hesitation if it's not working? That's a personality. Let me try and put this in some perspective. Jen, can we go back and let's replay the early trade this morning, please? Okay, so we're going to replay this morning, and we're going to replay at, we're going to start off with 5 times normal speed. So reflect on, remember where last is, remember where the settle is, and remember where yesterday's high is. Okay, so we had news this morning, and prior to the opening, the market was trading up on that news. Okay, stop for 1 second. The first anchor you see is the market traded exactly or within a tick of yesterday's high. That is an anchor. Traders went exactly to that level and they bought it. They think that's value, or they think that's a really, attractive place to buy. They've established a value on that that's unrealistic. The odds, when I see that mechanical exactness happen, the odds are very high that we will come back through that mechanical reference. That would be considered a weak reference, and it's a weak reference because it was within a single tick of a prior high or a prior reference. So this is a weak low this morning. The A period low is weak. Now it's good because there's single prints, but it's weak because it's within a tick of yesterday's high. Jen, continue to play. Okay, so you saw the market come back down through that, okay? Remember, we said the odds were pretty good. We would come back down through that, and we did. Okay, now stop again, please. Short-term traders, it's tough to read these markets. But if you look in the volume, when it looked below yesterday's high, white is the lightest volume, red is the heaviest, and pink is medium. So the market did come down and take out that anchor, traded down on low volume, and then bounced back to the upside. Okay, so that low volume at that moment in time suggested we were going higher. Okay, continue to play. Remember, we're at 5 times normal speed. Stop a second. Notice 2 or 3 times the market came down exactly to the overnight high. You need, when we talk about chunking, you need to observe that. Came exactly to the overnight high and they bought it 2 or 3 times. That is another indication that the buying that we're seeing in this market this morning is weak because they're buying exactly at another reference. Okay, continue to play. Okay, so you see we did come back down through that, right? Okay, so the market breaks. They bounced it again from just about yesterday's high. Stop a second, please. Once you re-enter a previous day's high, pretty good odds that you're going to do some very serious damage to the other side. Okay, continue to play, please. Keep your eye on last. Watch last. Okay, one more time. 1 tick below last. Last is weak, good odds we're coming back through it. Okay, stop, please. Now, when I look at all the information as of right now, 1, we looked above yesterday's high and we came back in. That always gets my attention. That good possibility that we do some more serious damage to the downside. Doesn't have to happen. It's one piece. When we're talking about chunking, it's one piece. We looked above yesterday's high, we came back in. Second piece of chunking, the initial reference that we used was the high, as I think that was our initial anchor, and the market bounced from that, then came back. That's weak. So that's 2 pieces of chunk. Now, the market has come back in. It came back in also into the overnight, looked above the overnight range and came back in. Another negative. Now, the next piece of negative in here is the last. So we got a chunk. It's an anchor. It is an anchor because it looked exactly at the last trade from yesterday. And we said the CME puts out last and settle. Traders use both of those as anchors. So now we're looking at this and we've got multiple pieces of information that form the chunk that this market is weak. All right, let's continue to play, please. See, traders, they're buying it again at last. Look at that. How many times they're buying it at last? Note that's weak trading. So we've taken that, we've taken that out. Now, the next thing they're going to be looking at is the overnight point of control. It's 15 wide, and we said the more prominent an overnight point of control is, the greater the odds it will be revisited. The next lower reference will be that and the settle. So you see it one tick above the overnight point of control. That's another anchor that they've used. When I see constant buying at these anchors, that is short-term traders. Now, let me stop 1 second, please. Here's where different personalities come into play. For example, when it went down to the overnight point of control, one tick above it, an anchor trader, you can make an anchor buy there if you want to do trades and you're very quick, you're very decisive, and you understand the personality and you understand the odds are pretty good that these short-term traders are going to buy there. That's what they see. Oh, they're looking at they're making that a value area, not value like we talk about during the day, but they're seeing that as, boy, that's just that's a great buy there. They've established that as being value in their mind. It's not realistic, but that's what they do. Trading is understanding, short-term trading hinges so much on understanding the behavioral characteristics of those that you are competing against. So you got two personalities. One, for the anchor trader, can buy this trade knowing that the odds are pretty high that they're going to bounce. If the trade doesn't work, you have to be out immediately. This is why the personality has to be decisive. The developed trader, which I'm a developed trader, I'm using all this information about these anchors this morning, and I'm short this market. And the anchors are confirming what the short-term traders, the daytime frame traders are doing at these anchors, are confirming to me that my trade on the short side is the right trade. Okay, continue to play, please. All right, look one more time. Look at overnight half back. They did the same thing at overnight half back. One tick below it. Again, that is another anchor. So what we have a market that has looked above yesterday's range. It's come back in, and these short-term traders who still have it in their mind that all things are up, they're buying every mechanical reference. And remember, somebody said, why yesterday, why mechanical? Because you can see them. You can see, we already identified half back from overnight as an anchor. Prominent point of control overnight as an anchor. the last as an anchor, the settle as an anchor. The previous day's high is going to be an anchor. The overnight high is going to be an anchor. What you're seeing here is what these short-term daytime frame traders are doing at every one of these anchors. The developer, I'm using this knowing this, I'm seeing these are the weakest hands traders when they're buying at these artificial or mechanical levels. Those are the weakest hand traders. That is confirming to me as a developed trader that I want to be on the short side of the market. All right, this is as far as we're going to go.
I was just going to interject and just reiterate. So, you know, Jim's given you wonderful examples of how, you know, just from this morning, how both types of traders could have used the information differently and taken trades. So
absolutely. When we talked about these anchors this morning, think about how many of these short-term traders bought one anchor, got stopped out, bought another anchor, got stopped out, bought another anchor, got stopped out. You ever had a day like that? And then you get stubborn and you buy it every time it breaks and you get stopped out. I'm going to guess out there the short-term trader's been stopped out 3 or 4 times this morning, and they missed a great opportunity on the market to the downside. Also, when you look above a previous day's range, you always have to be alert for the market to trade to the opposite extreme. All right, we've covered a tremendous amount of information in a very short period of time. This is what you have to learn to deal with if you're going to be a successful trader. Is it hard? You're damn right it's hard. It's hard emotionally, but the first thing, it starts with market understanding, then you get the chunking so you can see what's going on, and then it becomes self-understanding. It's not easy, and it takes time and it takes experience.